fourth quarter 2022 has been a pretty good quarter for us overall, and we're happy with the results. But most importantly, we're happy with all the planning that we put in place to undertake a work program in the Montney. And we've taken advantage of a couple of windows of opportunity that have presented itself. And so from my side, I'm really quite excited, looking forward to the results that the Montney is going to deliver. Obviously, operations this month and next month look to be doing very, very well. So I'm pleased with that. But with that said, I'll introduce, we have Jordan Keeble with us today, our CEO. We have Mark Freeman, our finance director, Carl DeMong, who's one of our directors and is responsible for the Montney program, and also Jerry Lamb, our CFO, based in Calgary. So with that said, I'll hand over to the rest of the team. But I think over the next few weeks, this Montney program is going to be quite exciting. I'm personally quite pleased that we've gone back to the Montney. We want to test that upper horizon for a liquids window. And after the years that we've been sitting there patiently preserving the asset, I think this will be a really, really exciting time for us. So I'll hand over to the rest of the team.
Thanks, Glenn. As Glenn has highlighted, we didn't have a phenomenal Q4 quarter, but overall for the 2022 year, we had a stellar result. Total production was just over 1.4 million barrels of oil and gas equivalent, and we averaged about 3,921 barrels, which is a 23% increase over our average production from the previous year. Importantly, the Q4 program that was undertaken late in the quarter has generated a phenomenal result for the company, with overall production for January averaging 4,500 BOE, and our current production is 4,700 barrels of oil per day equivalent. Quarterly sales are 24.2 million with earnings of just on 11 million. And our total revenue for the year was 122.5 million with our adjusted earnings of 66.8 million. I will get Jerry to run through in detail on our hedging, but as we know, we had hedging obligations with our bank requirements that we had to put in place in 21 that had a significant negative impact on our 2022 production revenue net earnings of a negative 16.3 million. Importantly, we no longer have any of those swaps in place. We've cleared them out and we've replaced them with collars that Jerry will run through, and we can comfortably say that we hopefully shouldn't experience additional losses in that respect, but we get access to the upside. I'm going to pass on to Jordan, who will run through our activities for the quarter.
Thanks, Mark. Hi everyone. From an operational perspective, in the fourth quarter of 2022, Calima successfully drilled 5 wells in our Brooks area. 3 of the wells were Gemini wells, which are in the Sunburst Formation, and 2 of the wells were Pisces wells, which were in the Glauconitic Formation. The performance of the 3 Gemini wells on average has met or exceeded our budgetary expectations. We did have some cost overruns on the Gemini program as we lost some downhole tools in Gemini 12, which contributed to a budget overrun in Q4. As well, from an operational standpoint, some of our production was curtailed in the fourth quarter due to some third-party gas takeaway constraints, which have since been alleviated. We also, in the fourth quarter, had some adverse weather in the Brooks area. However, the downtime related to that extreme weather was minimized due to some pre-planning and just being proactive by our field team. So kudos to those guys. Comparatively to some of our peers, we experienced much less downtime during the extreme weather than we had heard from some of our neighbors. So some pre-planning helped us out a lot on that one. The 2 Pisces wells that were drilled late in the year and brought in production here in the first quarter, they've only been on production for 1 month. However, they're currently exceeding our budgetary expectations significantly. So the combination of those 3 Gemini wells being ahead of our budget curve currently, and the 2 Pisces wells having a higher than expected IP30, has resulted in record production rates for the company. As Mark has mentioned, we're currently over 4,700 BOEs per day. The average for January was over 4,500 BOEs per day. And with some of our current drilling program, we still have 2 wells behind pipe that are going to be brought into production later in Q1. As part of the Q1 program, we drilled 2 more Pisces wells, Pisces 8 and 9. That drilling program is just finishing up now as we speak. 2 more wells at Brooks, of course. Those were both extended reach horizontal wells in the Glauconitic Formation, and they are a follow-up to a very successful well drilled by Blackspur back in 2020. These 2 wells that we drilled, Pisces 8 and 9, are longer. They have more frac stages than that 2020 well. So we do expect quite a bit of performance out of these wells. Fracture completion for those wells is scheduled for the second half of February, with initial production expected for mid-March. Both these wells were drilled off of a pad. So we drilled the wells back to back, which creates a lot of efficiencies for us on the costs and moving in equipment. Anytime you can drill 2 wells off the same site or more, you have a lot of efficiencies that you can realize. And as a result, the fracture completion for each of the wells will also happen back to back, one right after the other. So we had to wait for the 2 wells to be drilled. Next step is to get those 2 wells fracked. And we are expecting them to be having their initial production around the first couple weeks of March. So not only are we at record production right now, we had an excellent January. Production is up, production is high, and we got 2 more wells coming on before right at the end of the quarter that will be also very helpful. So you can see here on the table in front of you, we're forecasting for the first quarter of 2023 an average production of 4378 BOEs per day, 65% liquids percentage, which is slightly higher than what we had in the fourth quarter of 2022. And that's a result of our most recent wells being oilier, more on the oily side compared to some previous wells. So it's dragging up our oil weighting percentage. So the revenue related to not only this high production, but not including the 2 new Pisces 8 and 9, those are budgeted to come on production in Q2. So there is, we may realize a bit of that production if all goes well and the weather cooperates. So what the numbers you see here are based solely on what we've already drilled and the wells that are currently producing and what we expect for the first quarter. Cash flow from operations for Q1, again, just based on the current wells that are producing, is estimated at $10 million for the quarter. So really looking forward to two more wells coming on that are longer, more fracs, and will be very complementary to our current high production. But again, just budgeted for the second quarter, over and above what you see there in front of you. Next, we'll have a bit of an update here on the Montney. I want to introduce Carl Demong. He is our director, technical director, and in charge of all things Montney here in the office. So Carl, if you could welcome and please give everybody an update on what we're doing in the Montney.
Oh, I appreciate that, Jordan. We are currently mobilizing crews into the A54C Tommy Lakes pad with the Calima 2 and Calima 3 horizontal wells in the upper Montney and the middle Montney. We had the opportunity this year, because of other offset operators working in our area, we had the ability to leverage on their logistics and road preparation. So instead, we probably saved in excess of $500,000 in terms of road and construction costs for our winter program. So it was quite an opportunity for us. The testing program that was undertaken previously was truncated early or in a shorter test due to poor weather conditions and the end of winter. So the original tests of the Montney wells, the Calima 2 and Calima 3, were not long enough in order to give full information on the capability of the wells. So what we're doing now is we're going up there with crews. We're going to set up testers and test both wells at the same time. And as Glenn mentioned, we're really interested in what the liquids cut and the liquids content on these wells will be. They needed to be tested longer to get to those, to get to better numbers, and we intend to do that over the coming weeks. Then they'll be shut in for an extended build-up period to determine more about the reservoir properties. We are, like I say, we are in the process of mobilizing, and we should be testing here relatively shortly. We expect to have results on the flow side in the next few weeks, and on the reservoir side in a matter of a couple of quarters down the line. So like I say, it's in progress. So we're pretty excited to be doing it, and we're glad to be back up there. We're excited about the prospects, and we're pretty pumped to be up there. And I can't wait to do the next call where we can tell you something about the results. So anyway, at this point, I'd like to introduce Jerry Lamb, our CFO, and to talk more about pricing and hedging.
Thanks, Carl. Yeah, just to get into pricing, I guess as Mark had mentioned, pricing really fluctuated in 2022, particularly in the fourth quarter, and the WTI price was lower by 10% from Q3 to Q4, and more importantly, the WCS price for us was lower by 20%. Just to give you an idea of the WCS differential, in September 2023, the WCS differential was $19.60 US, and then by December 2023, it had risen to $29.50 US, which is almost $40 differential Canadian. A few reasons for this: some seasonal turnovers, but there was also some unseasonal things that happened. Particularly there are some refinery fires in the U.S., and the U.S. Government released some barrels from the strategic reserve in the fourth quarter to try to bring down the oil price. So that was part of the reason why these differentials sort of blew out in the fourth quarter. In January, the differential has started to come back down. I believe it's averaged $24.50 US in the month of January, and I believe today the differential was actually $22.90 US. So it's been heading in the right direction since the beginning of the year, and we continue to monitor it to see where it's going. But I think the general consensus right now is it should tighten back down to the levels that we had seen earlier in 2022, in around the $15 US range.
Jerry, if I can just add one more quick thing too, with relation to the WCS differentials, there's a major pipeline project in Canada that is scheduled to come online at the end of this year or into Q1 of 2024. It's called the Trans Mountain Expansion. And what that's going to do is take an incremental 580,000 barrels per day of Alberta oil to the west coast of Canada in Burnaby, BC. So one of the reasons we're seeing a tightening of the differential is the anticipation of this big project coming online. It's 90% complete. It's scheduled to come online at the end of the year, early in Q1. And when we start taking 580,000 barrels per day of incremental oil out of Alberta, that's going to create a demand for more WCS oil to hit Tidewater and make its way over to Asia. So as we get closer and closer to the completion of that project, I think we're going to see more positive effects on the WCS differential.
Thanks, Jordan. Yeah, so we obviously are very proactive in a hedging program. Last year, as Mark mentioned, the hedging program was sort of forced on the company by the state of the balance sheet, and therefore they couldn't control the timing. The timing wasn't controlled, and their hedges were put in place, primarily by the bank notes, and that resulted in obviously a $16.3 million loss for the company. This year, we don't have the problems with the balance sheet. We have quite a strong balance sheet. We continue a hedging program, and we've changed the hedging program, which used to be swaps, to really three ways. That allows us to protect the bottom side, but still participate in the upside. So we have hedged out to the third quarter of 2023, 400 barrels for the first quarter of the year, 400 barrels for the second quarter of the year, and 250 barrels for the third quarter of the year. To read the chart that we have in front of us, for the first quarter of the year, it's 110.05, which essentially means if WTI averages above 110.05, we get 110.05. The 82.50 basically means between 110.05 and 82.50, we get the market price. Anything under from 62.50 to 82.50, we receive $82.50. So that's sort of the bottom side protection. And any time WTI goes under 62.50, we basically receive market price for WTI plus another $20. For the second quarter, obviously, it's much the same, other than the sold call and the bought put has gone down by $2.50. And we continue to monitor and try to place hedges as you know, that are strategically beneficial to the company and can protect our downside while allowing us to, again, still participate in the upside. Just a quick note, we also have WCS hedges in place that we again continue to monitor. Right now, we would look at placing hedges at our advantage, but we do have the advantage right now of having the WCS differential falling. So we again monitor it daily, and when it is appropriate for us to place another hedge, we will do that. So with that being said, I will turn it back over to Mark and to carry on the presentation.
Thanks all. So that ends our quarterly update. We have a few